Standard advice usually tells you to keep either a 6-month emergency fund or hoard a massive 10-year cash reserve. Both of those extremes are dangerous. In the next 6 minutes, we are going to calculate your exact optimal cash buffer, down to the dollar, so you can survive any major market crash. To do this, you need 3 things: an estimate of your annual retirement budget, your guaranteed income statements, and a calculator. Once you calculate this precise mathematical number, market panic stops being a threat. It becomes a calculated waiting game. Before we calculate your number, you need to understand the math we are trying to avoid. The specific threat is sequence of returns risk. This happens when you are forced to sell your shares at trough prices during a crash, permanently destroying your wealth. Look at this grid representing a $1 million portfolio made of 100 shares worth $10,000 each. Under normal market conditions, if you need to raise $50,000 for living expenses, you sell exactly 5 shares. But if the market drops by 50, only count fixed, reliable checks. This diagram shows how we find your spending gap. Subtract your guaranteed annual income from your total living expenses. If you need $70,000 to live and receive $30,000 from Social Security and pensions, your spending gap is $40,000. By calculating your needs based on this spending gap rather than your total expenses, you drastically reduce the amount of cash you have to sideline. This keeps more of your wealth actively invested for growth. Step 4. Multiply your calculated spending gap by 2.5. This is your final cash buffer target. This historical timeline charts the 2008 financial crisis. The S&P 500 fell nearly 57%, taking about 17 months to hit the absolute bottom. If we expand this data to the 2000.com crash, that downward slide lasted roughly 30 months. A 2.5-year block of cash successfully spans the duration of both of these historical drops. A common mathematical mistake is multiplying your total expenses by 2.5 instead of the spending gap. As you can see in this comparison, doing that traps an extra $75,000 in a cash account. Holding excessive cash beyond that 2.5-year gap subjects your wealth to severe inflation loss and opportunity cost. You avoid the stock crash, but you incur a hidden penalty known as cash drag. Step 5. This calculated cash must be parked securely. Keep it in a high-yield savings account or short-term U.S. Treasury bills. Leaving this buffer in a checking account guarantees inflation will erode it. Putting it into volatile bond funds defeats the purpose of having a safe harbor in the first place. There are strict rules for using this money. The primary rule is that you only draw down from this cash buffer when the broader stock market is down. The secondary rule dictates when you refill it. When the stock market is in a strong bull run, you take profits from your stocks to build your cash buffer back up to that 2.5-year target. A true retirement cash buffer is an active tool. It is deployed defensively based on market conditions, not left to stagnate like a passive emergency fund. Look at the final number you just calculated. That specific dollar amount is your personalized optimal cash buffer. You not possess a mathematically backed shield. It is capable of getting you through a 50% market crash without ever having to sell your shares at a loss. Your final step is to log into your bank or brokerage account today. Check your current cash balance and reallocate your funds to match this target. Surviving the next inevitable market crash without permanent wealth destruction is purely a matter of preparation, not prediction.